silver is about 80% lower than it was at the peak in the 70s in terms of silver relative to money supply. If you look at the quarterly chart, I think we're on the verge of seeing a quarterly high, which would be around 40, 45. I know silver reached the 50 level, but that's the quarterly candle. And I think that's the first step. Once we hit that level, everyone and their mother will be talking about the cup and handle of silver, which usually when you have that type of formation, you see a major breakout. And in my view, we're about to see the monetary side of silver in a large way, as we tend to see throughout history. Isn't it insane that we're at 33, 34, even flirting 35 level, and the gold to silver ratio is at a 90?
Silver is currently significantly undervalued compared to historical levels, about 80% lower relative to the money supply than its peak in the 1970s. Analysts suggest that silver is approaching a key breakout level around $40 to $45, with a potential for a more significant rally once it surpasses this threshold. If silver reaches this level, widespread attention may drive further momentum, forming a classic cup and handle pattern, which historically signals a significant breakout. Currently, silver is fluctuating around $33 to $35, with the gold to silver ratio at 90, indicating that silver remains relatively cheap compared to gold. Tavi Costa, a global macro investor, explains that gold is often evaluated about the broader economy, particularly against money supply and national debt. While short-term price movements can be volatile, a long-term perspective reveals that gold reserves have significantly declined relative to U.S. debt. In the 1940s, gold reserves covered nearly 40% of the debt. But as the U.S. increased the money supply to finance wars and economic expansion, this ratio dropped drastically. Today, gold reserves cover only about 2% of total debt, highlighting a potential need for revaluation or accumulation of gold to restore its role as a financial anchor. Given this historical trend, there is speculation that the U.S. may once again become a major buyer of gold. A significant revaluation of gold prices or increased government purchases could stabilize the financial system and support the treasury market. While the U.S. is not at immediate risk of losing its reserve currency status, its economic policies and reliance on debt suggest that a shift toward bolstering gold reserves could be a strategic move to maintain financial stability. Before watching the video, subscribe and hit the bell icon to stay updated with our latest uploads. We'd love to hear your thoughts, so comment below.
Certainly, I think it's a way of valuing gold itself. It's a way of getting all these noise of the short-term movements we've had, and especially the upside that we had recently, the appreciation in gold prices from a trading standpoint can be a bit scary because you're obviously, the immediately thing you do as a trader, not as an investor, is to be a little concerned about this, such a large movement in the short term. Now, this chart helps you to have a sense of what could be ahead of us. And so the U.S. economy, a lot of folks have tried to value gold relative to other things like money supply, particularly the monetary base. I think the research that a lot of people have put out regarding gold versus the monetary base is not as relevant. Monetary base is only $2 to $3 trillion. It's really nothing relative to the size of the economy. We're talking about $30 trillion economy. Who cares about $2 trillion here? On that scheme of things, on top of it, even money supply, you look at money supply, we're hovering around $20 trillion, a little more than that. And, again, the economy is $30 trillion. And on top of it, what we do have is an outstanding amount of debt of close to $36 trillion. So take that number, go back in history. That's what I was trying to accomplish with that chart. What's the outstanding amount of debt? And then relative to how much we have of gold reserves. And you can see clearly throughout history that we've had many situations where gold reserves used to be close to, way above what it is today. Back in the 1940s, used to be close to 40%. And then the U.S. had to increase money supply by 150% and leverage up to finance the debt for the war. And so that moment was why you saw the reserves falling relative to U.S. debt. And today we're about 2%. If you only go back to the 1970s, which used to be about 17%, you get it back to about, over $20,000 an ounce. So in my view, the potential for either a revaluation of gold, which would be one way to fix this issue of the reserves, becoming an anchor again for the treasury market, is one thing. And the second way would be through accumulation of gold itself. And a lot of people have dismissed the potential for that to occur again, meaning the U.S. becoming a large buyer of gold itself. And I think that could certainly be a moment in history that we could be returning to. We haven't seen this in many decades, and I wouldn't shock me at all if we are in the process of seeing the increase of gold reserves once again by the U.S. economy, and that would be, we're flirting with, we're not losing the reserve currency status, but we're flirting with it certainly.
Tavi Costa highlights a significant shift in global markets, with investors moving away from U.S. equities and into international assets. While past rotations were primarily between growth and value stocks, the current trend is a broader global rebalancing. As the U.S. economy struggles, markets in China, Brazil, and Europe outperform, indicating a shift in investor sentiment. The MSCI World Index remains heavily weighted toward U.S. equities, but this dominance will likely change as capital flows into other regions. One key driver of this shift is the weakening U.S. dollar. Over the past decade, the dollar has been strong, limiting commodity and emerging market performance. However, as the dollar starts to decline, commodities and emerging markets stand to benefit significantly. Additionally, the U.S. may need to lower interest rates to manage its debt, reducing the dollar's strength. This creates a more favorable environment for emerging markets, attracting capital inflows and reducing investment risk compared to previous years. Now, let's jump into the interview.
Despite the fact that we let the currency go, at least we kept our gold. And I'm speaking, although I'm Brazilian, I'm speaking as a U.S. I'm a U.S. citizen. Although I'm not a U.S. citizen either, but a U.S. worker. But what's funny about all this is that now we're entering a world where, when you look at the dollar itself, and there's a chart in that letter that I show the valuation of the U.S. dollar versus other fiat currencies. And that's such a relevant chart because there are only two other times in history we've had hitting this level of extremely overvalued period of the dollar versus other fiat currencies. The moment when people used to talk about, the dollar is the cleanest of all dirty shirts, that, if you're an investor, that's you're not really doing anything about saying this. I mean, you're really reporting the past. No, that's been what's been happening for the last few years. As an investor, you want to pay attention to what's ahead. You can't just say that when the U.S. is in its most overvalued levels in history relative to other fiat currencies, not just other hard assets. And so I think that if you look at those two precedents that we had in history, it was 1985 and 1930s. 1985, we saw a coordinated act to devalue the dollar. That was an important period. We devalued the dollar quite significantly, and that sort of inflated the Japanese bubble, and emerging markets did very well. And, all sorts of markets internationally were benefited tremendously from those flows that came out of the dollar into other things. 1930s. We're in the middle of the Great Depression, 1929, market peaked, and so internationally, the global economy was at a stage where things were very negative at that time. And so 1931 came in, a bunch of countries, the UK, Germany, Japan, Canada, Austria, very large economies of the time, end up saying, well, we cannot hold this gold standard domestically. So they broke the gold standard in 1931. And so that level of lack of discipline, monetarily speaking, caused the U.S. dollar to actually rally during that period. This is why you see at that chart that I'm talking about that the dollar versus other fiat currencies rallied tremendously at that time and peaked in 1933. 1933 came in, Roosevelt was, supposedly, there were all central banks and monetary authorities were meeting in London, supposedly, to discuss ways of stop this issue with lack of growth internationally, maybe revitalize the global economy in some ways of trading and maybe a new ideas on the monetary side as well. But guess what? The U.S. didn't want to do any of that. Why is that? Because the conversations were not going in the same direction. The U.S. needed to devalue its currency quite drastically, which was something that other economies, were a little bit concerned and maybe not in the same page. And so Roosevelt came out of that conference in a very disruptive manner and ended up devaluing the dollar versus gold, which caused what? And the dollar actually devalued versus other fiat currencies as well. So I think we're kind of in a similar moment right now where most fiat currencies have devalued versus the dollar recently, like i.e. the dollar is the cleanest of all dirty shirts. And now we're at a peak level where we need to devalue the dollar quite substantially in order to restore growth globally again. Well, in 2021, 2022, we saw a rotation from growth to value, of which we kind of reversed that rotation again. But I would say we're seeing something a lot more significant now, which I think it's maybe sort of a global rebalancing. It's out of U.S. into other places. We noticed today and this other few days that the U.S. economy has been struggling. You're seeing Chinese equities and Brazilian equities and other parts of the world, European equities, European banks outperforming mega caps. All these signs are showing to investors that there is a rotation, or I call it the global rebalancing, out of U.S. equities into other things. I mean, MSCI World Index weight is at a 70% of U.S. equities versus all other countries have, small single digits. And so there has to be a change of that. And I think we're in the process of seeing that. And so I'm paying close attention to this. And so my view is that there's going to be a lot more of that. And so commodities will be one big beneficiary of that. We've all shown this chart of commodities to equity ratio being at, 50, 60-year lows. And the big question is, well, it's been there for a long time and it never turned. I think the biggest reason why it hasn't turned is because the dollar hasn't turned. The dollar has been performing very well. But when you take a look at the 10-year performance of the dollar, it's starting to roll over. And as you can notice, especially year to date, other fiat currencies are up quite significantly relative to the dollar itself. And I think that's the beginning of that rotation or rebalancing. And so commodities should perform very well. Emerging markets, in my view, should do very, very well because it's a green light on their economy. What's the green light on their economy is when you cap yields and you cap the dollar. You can't have a stronger dollar from here. So that means you got to cap it. The same thing goes to interest rates. And, the U.S. can leverage up more, but it has to lower the cost of the debt. So that means lowering rates quite substantially. If that's the case, the dollar has to give up on its strength. And so that means emerging markets have much lower risk than initially perceived maybe a year ago. And so those things are going to change quite a lot, and it will probably provide attract big inflows of capital as we see the dollar losing its value versus other fiat currencies.
Shifting market dynamics, a weakening U.S. dollar and national debt concerns drive investors toward commodities, gold, and international assets. Silver remains historically undervalued, while gold's role as a financial anchor may grow as debt levels rise. Meanwhile, emerging markets are gaining traction as capital flows away from U.S. equities, signaling a potential long-term shift in global investment trends. How might a continued decline in the U.S. dollar impact global markets and commodity prices? Could a significant increase in U.S. gold reserves alter the balance of the international monetary system? Drop your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for being part of our community.